Zaid, so excited to have this conversation with you here today. Thanks for joining. Um, yeah, maybe we can just kind of start with, would love to let our listeners hear a little bit more about, your background, tons of tech experience, and what's brought you into construction tech.
Thank you so much, Kevin, for having me on this. Been excited to do this for a while. Yeah, no, so quickly on my background, Indian originally, grew up in Dubai. Um, my parents actually are in the construction business. So my father runs a mid-sized construction company in the Middle East. Both my sisters actually are architects as well. And my uncle runs an architectural consulting firm. So quite literally, my entire family is in the construction business. But yeah, growing up in Dubai was sort of surreal, just seeing a lot of construction, all the sort of high rises being built right in front of my eyes. And so that sort of got me into construction at a very early age. But I was also always into a lot of technology. And so started a company right before I got to college in the education software industry. And so I decided to take a gap year from college. I was going to go to New York, started doing that, and ended up selling that company to PE, and then after that moved to San Francisco. I was lucky, my parents still wanted me to go to college. I was lucky to get into something called the TL Fellowship, where they basically pick kids who don't want to go to college, give them 100 grand with one condition, that you definitely can't go to college. So was lucky to do that, moved to San Francisco as part of that, and started my second company, which was Volley. It was an artificial intelligence startup. Basically, the premise of the company was the world is going through a knowledge explosion. Google exists, but it kind of sucks from a learning perspective. And so let's build way better tools to, teach kids. And so built that company, was used by lots of different institutions and even big companies. Ended up sort of leaving that company in 2018, have been investing a ton. Wear multiple hats, but really got into Flexbase, my current startup, about 18 months ago. And really the premise for this was, as I mentioned, my family is in the construction space and naturally saw a lot of different struggles that they went through growing up. And the main thing that would come up again and again was cash flow, or the lack of cash flow. I just remember sitting around the dinner table and my parents talking about how, they're struggling to make the next payroll and, pay suppliers on time and rent equipment and so on. And through that experience, I just realized that finance was the biggest challenge in the construction industry. And so that's what I've decided to sort of focus on solving on for the next sort of stage of my career.
Yeah, that's awesome. Thanks for the intro, Zaid, and congrats on the Teal Fellowship. That's so cool. And I've got lots of questions and comments on cash flow and construction industry, and probably quite a theme for this call. Right before we dive into that, did you want to maybe share with our listeners Flexbase, what it does, and
Absolutely.
we're very excited to be partnering with you, but
Yeah.
maybe you can tell everyone why why we're so excited.
Yeah. So, this is, this is probably the most important company or project I've been involved in. And, cash flow is a problem that pretty much any small to medium sized business faces, right? Cash flow, making payroll, paying people on time. And really, the place this comes from is construction is one of these industries where money coming in is usually way slower than money going out. And so you're always buying stuff way ahead of time before your client pays you. And so it's on average about 100 days late, which is kind of insane. There's actually no other industry, to my knowledge, where there's a 100-day lag in most payments. And if you think about working capital that's available to these companies to make expenses meet, um, it's actually quite difficult to get working capital. It's usually a very long-winded process where you're talking to banks and, sketchy sort of credit funds and so on. And usually what ends up happening is either you get rejected, or if you do get accepted, the interest you're paying is so insane that it eats up your entire profit margin. I mean, we have seen as high as 100% APRs, which is, straight up, in my opinion, illegal, right? And then if you dive one layer deeper, if you look at the finance layer of most companies, right, the finance layer of companies is also quite broken. You have companies using multiple bank accounts. They might be using credit cards, often their own personal credit cards for business purposes. They might be using stuff like QuickBooks, Excel, payroll software, project management. So there's a ton of stuff. And so it's quite fragmented still in 2022. And it's not really changed in the last 20, 30 years. And so we think there's an opportunity to consolidate every single aspect of your business's finance into one platform. And we call it a finance super app. And so we launched our first major product being a business credit card, where we give you super high limits within 5 minutes based on not just your credit score, but your actual business income. And the way we do that is we plug into the business's bank account, and very quickly we can tell what the business's revenues and cash flows are. But the headline feature is we give 0% interest for 60 days. Effectively, you get a free loan for 2 months. And so with that, you can buy now and then pay later, which is massively helpful in an industry that has significant cash flow difficulties. And so that product has been so successful that we've had actually a number of merchants approach us saying, hey, would you offer 60-day float to my customers? We want to offer net 60 terms to our customers. And so that sort of led us to where we are today with Dozer, where we have built the industry's first buy now, pay later designed for businesses, where basically a business can buy any business purchase and have 60-day terms on the payment. And in the future, we'll launch financing beyond the 60 days as well. So if you're buying some equipment or something like that, there's room to expand. And so what we're really excited to partner with Dozer on is, if you think about construction equipment, the equipment industry, either the equipment suppliers are running quasi banks and, they don't know how to run a bank, they don't know how to underwrite, they don't know how to collect funds, or they offer no financing whatsoever, no payment terms. And so I think Flexbase sort of alleviates this concern for both sides, where with a 5-minute application, we can approve, literally $50,000 to $250,000 credit lines to make sure that people have enough time to pay for what they need.
So that's incredible. It's incredible. I know our customers are excited, and Dozer's, one of our pillars is being customer obsessed, and one of the reason why we wanted to dive in on this. So let's dive in a little bit more on Cashflow. Would like to just kind of chat a little bit about why this cash flow problem exists. I've seen it firsthand being a contractor. I completely understand, that those payments go from expecting in 15 to 30 days, and next thing you know, they're 100 days later, you're still trying to collect. Can you describe that process a little bit more, and what it's like to be a contractor, and how long it takes to get paid?
Yeah, no, absolutely. Construction is one of the more unique industries where, if you're like, let's say you run a small consulting firm, or you're a lawyer, or you run a medical clinic. The typical invoicing process is, you send an invoice to the customer, and it's like a 1-page document. You could generate a PDF and send it via email. In that one-page document, there's a number, and the customer just pays that number, and usually that's within a few weeks. But construction is unique, where down to the invoicing process, how the invoice is approved, how the invoice is financed, there's so many workflows and nuances, right? So if you're in the commercial construction industry, for example, you're working on these sort of archaic documents that your listeners are familiar with, AIA forms and lien waivers and all these sorts of documentation that's different state by state in the United States. If you go to other countries like Canada, Canada has its own kind of set of documentation that's unique. And so you as a subcontractor or specialty contractor, you're sending this to the GC. The GC is then kind of approving that and then sending it to the developer / client. The client is then approving it, and that could be weeks of back and forth, at each step. And then that's being sent ultimately to a bank, and the bank oftentimes is doing its own review and making sure that all the compliance is in place and all the work that's being told that's completed is actually in fact completed. And then releasing funds, and then the funds kind of flow down this funnel back to the final stakeholder. And so oftentimes, if you're a smaller company, be it a specialty contractor or a supplier, you are literally, in best case scenario, 55 days away from being paid. But what's what's more typical is like 80 to 100 days. And that's, even that is sort of generous. In certain cases, we've seen it to be way, way longer. And then if you go on to the residential construction side, you have not as many documents per se, but you still have a ton of compliance that you need to do to make sure that, in an adverse scenario, you protect yourself. But then, you have clients who are perhaps not as cash rich. And so you then have to sort of kind of chase them. And, a lot of residential projects go belly up because clients just don't have enough money.
Right. Yeah. I mean, I was in the same, as I said, same space, both residential and commercial. And, first on the residential side, great to get the deposits, right? You got your 10% deposit when you get started, or 10% deposit to book, and, another, 30% to get started. And then good luck, collecting on that other 60%. You lose all your leverage by finishing the project as a contractor, and then all the leverage goes over to the person, the purchaser, and they may have started a project that was a little bit bigger than they expected, or for various reasons there's no way to collect, and it makes it very, very difficult for contractors. And then one other thing that I thought maybe I'd bring up, and I'm sure you've probably picked up on this and maybe you have some comments, is the with the commercial projects, there's always that 10% holdback at the end. And again, good luck collecting on that 10%. It's just as much work collecting the 10% as it was completing the project, in the first place. Sorry, go ahead there, Zaid.
Yeah, no, I was going to make a comment there. So when you were doing, when you were working directly in the construction industry, were you mostly doing projects in Canada?
Yeah.
Yeah. So one interesting thing that we've learned that's different between the Canadian and the US markets is that the US, a number of years back, basically removed the standard of doing the 10% advance. And the reason for that was they were seeing so much fraud and things like that they basically eliminated the 10%, but the advance payment, but they kept the 10% overhang, which is the so you're kind of being screwed on both sides.
Yes. Oh, it's going in the wrong direction. That's tough.
Yeah.
So the other thing on this that I wanted to add with the 10% is So yeah, almost impossible to collect that 10%. But then, building a good business is all about, relationships as well, right? So you're trying to have this really great relationship with, your customer, whoever that is, the GC or the homeowner, because you want to do their neighbors. And, say you've told them payment on completion, great, but really it's 30 days. 30 days is pretty normal. Uh, but if they start to go over, and they're now 15 days late from the 30-day payment terms, you've hit the 45-day mark. And in Canada, I'd love to learn about the US here, but that's our limit for being able to place a lien. So you can have this really great relationship with a GC or with, a homeowner that you're building a landscape for, in my case. And then your only option is at 44 days to place a lien on this person that you've got this great relationship with. And after that, you lose all leverage, right? So it's just a very, very difficult space. Are you seeing the same thing in the US?
Yeah, it's a little bit more than 15 days, but it's similar, right? Like you have, oftentimes we see customers. So we have, in addition to our financing product, we have a banking product and a payments product that we're super excited about. And in our payments product, we basically help customers, try to get paid faster from their clients. And what we often see is customers will just sit on their invoice. And we're like, hey, we're this amazing software that can automate the reminders and the lien notices and the legal documents necessary to get paid faster. And,
Right.
Most of our customers oftentimes will be, we'll say something along the lines that, hey, I would rather just wait because I don't want to mess up my relationship.
Right. Yeah. That doesn't surprise me at all. The relationship's a huge part, right? And I think that's where, the GCs and, even in residential construction, there's some leverage there over the contractor of, there's a carrot out front in waiting for that next job to fill up the pipeline of work, right? So it makes it very difficult as a contractor. A huge amount of sympathy for contractors and what they're doing.
Yeah, no, exactly. And I think the joke is so people think construction is funded by banks, but
Right.
it's really funded by construction companies. Construction companies are basically, especially in the US, when you don't have the advance payment often, you're basically acting as an unsecured lender with not that many rights, with really bad, payers who take advantage of the smaller guy. So
Right. And I think you could take that even one step further, that it's funded by the construction companies, but then the construction companies unintentionally end up pushing that debt or that funding back onto the smaller suppliers, the stone yards, the rental companies, maybe rent, pay up front, but then all of a sudden, something's extended and the cash flow just isn't there to pay. So again, a huge amount of sympathy, right? It's a systemic problem in
the wildest theory I've heard about this is, not to go into conspiracy, but the wildest theory here, which is kind of hilarious to me, is the larger general contractors, the ones that have billions in revenue, that employ, thousands of smaller companies, because they are large, they get really great lines of credits from banks. So banks are giving them literally hundreds of millions of dollars. So they have the capital to play around with. And that is why they're the ones winning all the projects, because they're the best financed, best insured, et cetera, et cetera. But then you go to the smaller companies, they don't have any financing. And oftentimes, they're the ones getting paid the last. And so the general contractors, the conspiracy says, basically are withholding the capital to generate interest revenue and using the revenue to basically expand their profits.
Right.
So when you have idle cash sitting in an account, that account can be generating 2, 3, 4%. In this rising rate environment, you could be literally making 4 or 5% on $10 million. That's like $500,000 for doing nothing.
Yeah. Right.
So.
Yeah, that's interesting. I haven't heard that one, but definitely something maybe I'll read it a little bit more into. You just touched on something though that I'd love to dig deeper. So um, let's talk more about why contractors find it difficult to get a line of credit. Why do
Yeah,
they have to lean on their suppliers and their credit cards?
yeah,
Why is it difficult?
yeah. No, it's a really important question, and it's actually the problem with construction companies is end of the day their cash flows are very lumpy, and so if you're
Mm-hmm.
a traditional bank just does not know how to underwrite lumpy cash flows. Um, they're looking at the company. They're used to very stable businesses like law firms and doctors' offices and whatnot, and then a construction business comes with their P&L, and suddenly you're looking at 3 months there's no money made, and then there's like a lot of money made, and then there's like debt, and like so it's often really hard to sort of underwrite these businesses. And so if you're not big enough, most banks or credit funds, even credit card companies, will basically just say, all right, we don't know how to underwrite this business. Let's just look at the business owner's credit score, and just do a little bit of diligence that this business is real, and give them the smallest possible credit line available. So if you're working with like an American Express, they'll give you 50,000 or 100,000 credit limit, when
All
you're
right.
even if you're making 10 million in revenue,
All
which
right.
is kind of insane, right? And so this kind of complicated underwriting process cannot be solved if technology is actually not built. And so what we have done is, through literally 15 months of a lot of hard work, we have built ways to actually understand the cash flows of a business going back 5 years by simply the user logging into their bank account in our application flow. We can figure out what's happened in the last 5 years and give a pretty accurate picture on how resilient is this business. And
Mm-hmm.
so, that sort of gives us the ability to provide sometimes quite literally 10 times more credit than a traditional bank.
Wow.
So if your limit is 50,000 with like an Amex or Capital One, we could literally go as high as $500,000 because we actually understand the business's quality.
And 0% for 60.
And 0% for 60.
Right? Great
It's
terms.
like it's like
Yeah.
it's the Amazon thing, right? Like you got to make the product so like so good that
Right.
you'll have to be stupid not to use it.
um, so one of the things that used to come up with my previous business, we were growing super fast. I'm just going to be kind of curious to see if you've run into this and have any comments. Debt to equity ratio was a thing that came up all the time, right? We're
Hmm.
growing really, really fast, and we had to buy a ton of equipment. Frankly, one of the reasons we started Dozer is we realized we probably should have been renting more than the amount that we were purchasing. But we were buying equipment, and then started to struggle to have access to enough equipment to be able to complete the jobs. We were very, very heavy into snow removal, so yeah, I remember that being a challenge. And then when we could buy it, we had to go to tier 2 and tier 3 banks, and we were paying unbelievable interest rates. You're right, your profits kind of end up going out the window just to these interest rates to be able to run the projects that you bid 6 months ago, not knowing if you were going to get it or not. But is that a contributing factor with Flexbase, the debt to equity ratio?
Yeah, so we do factor that, and we have mechanisms to figure out how much credit both the business owners and the business have, and we can
Mhm.
kind of figure out, all right, this is how much revenue this business is generating. This is what their kind of take home profit is, and we can estimate that using pretty complex data science models. And then we figure out, all right, so this is their monthly debt service. And so if we provided them capital, will they be able to pay it back in a timely manner? And the reality is that if you think about, and this is going into the weeds of how debt works for businesses, there are two categories of debt, right? There is
Mm-hmm.
short-term working capital and then
Yep.
long-term expansion capital. So
Mm-hmm.
if you're buying equipment, you're tapping into the expansion capital side of things. You're paying
Right.
whatever 20, 30, 40% APRs, sometimes lower if you're lucky. And you're getting 12 months, 24, 60, and it goes kind of on and on, as high as 10 years to pay back on expansion capital. The reality is that expansion capital is intended to grow businesses. And so if you
Right.
are if you're in a stage where you need to buy 10 large pieces of equipment, fine, tap into that, right? But
Right.
what we realize is that where there's basically no capital available is short-term working capital, right?
Right.
Which is like, hey, am I going to make this next payment tomorrow? Am
Right.
I going to be able to rent from Dozer today when I don't
Mm-hmm.
have the payment from my client yet? And so
Right.
that's the sort of large lake that's missing in today's sort of capital solutions. And so we've built probably the best short-term working capital solution out there. And we think that, providing customers with 60 days, no interest gives them, much lesser sort of debt burden, just sort of, use it for operational expenses mostly. So for example, if you're a tiny company and you're making runs at like Home Depot, you can
Right.
use Flexbase to go buy, some materials and pay us within 2 months, and we'll literally charge you no interest. So it's almost free financing.
Right. Yeah, I love that. Um, it gets me thinking of that lumpiness comment that you made earlier, right? I'm guessing that this the lumpiness and need for short-term capital is really due to the way the payments come in, right? The deposit structure. So you're getting 10, 20% down, you're maybe getting 30% to get started. And then you've got, if the project's 3 months, you could have no revenue for the next 3 months. You have to live off of the 30, 40% that you just brought in. But you still have to pay for people, fuel, materials, and then somehow make it to the end of the project. And to think that a contractor is, has 60% of the job as free cash flow or profit is just, outrageous. Right. I think that, what do you think contractors are normally bringing in, like a 10, 20, 30% profit margin?
Way lower than that. It's like we've seen as low as like 3%.
Right. Yeah. So they need help with this financing. They don't have 60 to 70% of the cash available to wait until the end of the project.
Yeah. I mean, we've honestly, like, the number one blocker to a company's growth in this industry is there's a reason why there are only like 5 guys who win all the projects in any given area, because those are the 5 guys who have the best financing and the best kind of resources to take on projects more and more, right? And so what we have seen is that, if you can solve this capital problem, both on the short and long term, you can basically outcompete anybody. So it's oftentimes not about relationships and business development. I mean, that's really important, but it's often just like having enough money to take on more projects. And so, we have a customer in Texas that we were talking to, and it was amazing. They told us that they were able to 3x their business by recycling funds more efficiently using Flexbase.
Wow.
Yeah.
That's so cool. Hey, can you, are you able to share any more details on that?
Yeah. We actually, we were so like blown away. We sent a camera crew down there and asked him to sort of explain his story. And so what this was like a $800,000 a year business when he started using Flexbase. And what he realized was he could, he figured out some sort of like pricing arbitrage where if he pays for materials up front, his profit margins actually go up significantly. And so he started paying for all the stuff up front. He has pretty good customers who are paying him within 50, 60 days. And so when the payment would come through, he would pay us. But because of the larger profit margin, he was then using that capital to grow other parts of his business. For example, hire additional salespeople to go and close additional customers. And so in very short order, I'm talking like 8-9 months, he was able to grow his team to a point where the sophistication of their operation grew meaningfully, such that they were able to win more customers. And that, additional 5, 10, 15% in profit is substantial for a construction business, right?
Yeah, it's game changing.
Yeah. And so, yeah, it was honestly like the coolest thing ever, seeing this customer talk about how, they frankly are just, their financial lives are meaningfully better, which is really our mission, like help people make more money.
So Zaid, you said something there that really resonated, and I've had this hypothesis for years that when it comes to the skill trades and building a great business, one is the ability that most people start with a skill and they're really great at the trade. Then they're really good at relationship building, maybe some organization skills, to get off the ground. But if you can nail that, the rest of it comes down to financing. And if you can have access to capital to be able to grow that business, you go from 1 crew to 2 crews to 100 crews. But you need the capital to be able to get past that first crew.
Yeah, no, exactly. And that's the exact right way to think about it. I think, let's be honest, people in this business are not good with money. That's just the honest reality, right? And they shouldn't be. Like, their core kind of skill set is, building buildings, right? So that's what they should focus on, and that's what they're good at, right? So, it's unfair for anybody to come in and say that, just get better at finances because you're a business owner. That's not how, skill sets in general work. And so, I think what we are trying to do is, we are trying to come in and say, you know what, we know that finance is a hassle for you. Let's give you the capital and the tools so that you don't need to worry about finance in general. It's sort of this thing in the background that's an autopilot, and you're focusing on your relationships, hiring more people. Hiring is super difficult in this environment still. And just winning more projects.
So maybe just a slightly different question for you. Just a broad question about FinTech in the construction industry. There seems to be a lot happening now. Why is now the time? What's changing that we're seeing more of this?
Yeah, no, I think what's interesting, and I'm a pretty active investor. I've invested in a number of FinTech companies. I think FinTech as a whole is having its kind of high school graduation moment, because all these technologies have existed for decades, right? Like, people have been building the underlying blocks for many, many years. But the challenge has always been that the technologies are too complicated to use, because the user experience, the layer that the customer interacts with is crappy. It's kind of like, there were mobile phones, and then the iPhone came out, and the iPhone, is so much better. And so I think FinTech is having this moment where the building blocks are ready. If you wanted to launch, a FinTech product that, was a bank product for construction businesses, if you have, enough engineering skill set, you could actually launch it within 6 months. Whereas, 10 years ago, it would have taken you 3 years just to get the licenses in order, if not more. And, licensing and compliance is so complicated in this industry. So you have the building blocks so simplified that you can build pretty much any user experience you want. And so the why now question is that the underlying foundation, the building blocks, the abstractions that allows you to build more stuff on top of is now ready, which wasn't the case, even 5 years ago.
So seeing that there's such a trend and opportunity with fintech and now coming to construction, are there any trends that you think that contractors should be jumping on, or on the other side, is there anything that they should be cautious of? Any sort of newer tech that hasn't yet been proven and there's some risk?
Yeah, I think what's interesting is COVID was a net positive for the construction industry. I mean, it was terrible for lots of reasons, but it was very positive for the construction industry, where we often talk to customers on Zoom now, and I can't imagine 3 years ago where our BD people would jump on a call with customers in construction on a Zoom call, right? Because so the adoption of technology and the digitization has grown so significantly that I think that now is an incredible opportunity for construction businesses where the people on the job site are actually open to adopting technology. Whereas before, if you were a business owner, let's say you were the most savvy business owner out there in construction, if your people don't want to use stuff, then there's no point, right? And because now they are willing to use stuff because of COVID, I think it's time to lean in even more and sort of adopt even more technology. And so in that vein, there's a lot of stuff happening around finance, Flexbase being, I like to think at the forefront of it in the construction industry. There's stuff happening around, managing equipment, dozer, etc. But then there's also a lot of stuff happening around how you bid on projects, where there are lots of platforms that allow you to bid more efficiently. There are scheduling platforms. There are platforms to sort of organize labor. There are literally hardware companies that help the sort of clock in, clock out process of workers much, much more efficiently. There's camera companies now that you can install a camera and it'll tell you how productive your job site is. So you could be literally sitting at home and you could tell, your crew number 2 is 70% productive, and there's 30% optimization yet to be done. There's all this stuff out there, and it's just if you Google for any potential problem in construction, I guarantee that there's a construction technology working on it.
Yeah, we're seeing the same thing. I just think there's so much opportunity for a contractor right now, and building a business looks a little bit different than when I was doing it 10, 15 years ago.
Yeah, I mean, the thought experiment there is like, what happens in like 20 years, right? Like if so much happened in the last, 24 months, what happens like looking deep into the next 20 years? I mean, fundamentally, every aspect of construction, planning, management, even the construction itself, there are companies like Canvas that literally are automating how you do drywall, where there's a robot that comes to the job site and literally sprays and gets it done. There are companies out there that are like Dusty Robotics that do the layouts in a building automatically. They sort of embed the schematic and then they go out and draw out these lines on a job floor, and it's just incredible to see how fast software and hardware in this industry is evolving.
Yeah, for sure. It gets me thinking. I mean, we all know that there's a shortage of labor in the skilled trades, and this is probably a little bit of a rabbit hole. I won't go too deep, but with all of these new products, fintech and otherwise, the others that you're sharing, it probably will impact the education system, and some of the skills that the trades will need to learn as they continue to grow. I'm probably going down a little bit too deep on your thought experiment there, but
no. But just like one analogy, just to like go one step deeper. If you think about a company like SpaceX and Elon Musk, right? Everybody is at this point familiar with him, but I think the piece that most people don't realize is when SpaceX initially started, their whole thesis was that, rocket launches rocket launches cost $500 million. How can we reduce the cost and time of a rocket launch by 90%?
Right.
Which is akin to saying like, hey, let's say a construction project costs, $10 million. Can you build it for $1 million?
Yeah.
Right.
And as well.
Yeah. And, like SpaceX actually solved that for rockets. Like, if you think about it, rockets are basically like metal, like screws, at the basic building block level, it's just like metal, right? So why does it cost so much? And so if you think about construction, arguably it's even more simple, right? Like it's like cement, wood, my hypothesis is that within the next 20 to 50 years, costs will actually go down as opposed to go up with technology. And so if you're a business owner, now's the time to adopt technology. Otherwise, you'll be in trouble. Yeah.
Love it, Zaid. Yeah. Really great conversation. I'm realizing we're probably a little bit getting close on time. I could keep chatting for the next 2 hours on this. One thing we like to do as a construction company is just kind of ask, do you have a favorite piece of equipment?
I would say let me think. I want to get this one right.
It's a hard question.
So, as a kid, I used to be fascinated by, like mobile cranes, because my father used to build lots of, 20, 30, 40 story buildings. I used to be fascinated how like the mobile cranes would come and like install the like fixed crane. And so, whenever I would see a crane, I'd be like, oh, we have like a new project. And so this is exciting. So, there's some like, I don't know, some emotional attachment with cranes for me, which is like a weird thing to say.
That's an awesome answer, awesome piece of equipment, and even better reason. I love it. So, Zaid, thanks again for coming. Just want to give you a chance to let everyone know where they can find you, your social handles, etc.
Yeah, you can learn more about Flexbase by going to flexbase.app. Flexbase is FLEXBASE.app. And you can find me on Twitter, Instagram, etc. by just typing Zaid RMN, ZAIDRMN. And
Awesome. Thanks so much, Zaid. This has been great, and looking forward to chatting some more.
Awesome. Thank you so much, Kevin. I appreciate it.